What are mutual funds? Well, mutual funds are essentially a pool of money that's collected from lots of different investors. So, instead of going out and buying things such as individual stocks or bonds, you buy into a mutual fund that buys a variety of different investments on your behalf. Think of it like buying a slice of a big investment pie. Now, one thing you might have heard about is things such as index funds or maybe ETFs. These are actually really similar to mutual funds, but with mutual funds, they're actually actively managed rather than being passively managed like the others. This means that you'll essentially have what is called a fund manager investing your money for you, buying and selling stocks on a daily basis. Now, in recent years, mutual funds have actually found themselves to be the least favourable choice of investment, mainly due to the higher fees that come with them. However, for some people, they can still be a really beneficial way to invest for a number of reasons, really. Number one, they may not quite understand the stock market or have the time to research individual stocks. Number two, they may want to have a completely hands-off approach to investing. And number three, they may be a little worried about the risks of investing and they want to just diversify their money with no worries at all. All of these are really great reasons to invest in a mutual fund, but once again, they do come at the expense of higher fees, which we'll get to in a moment. In terms of the types of mutual funds that you can choose from, there's quite a few out there, and it all really just depends on your goals. You've got things such as equity funds, which mainly focus on stocks and aim for growth. You then have fixed income funds, which invest more into bonds, giving you a little bit more stability. And then you can kind of get a bit of a mix of the both, which are normally called balance funds. Now, circling back to the fees that come with a mutual fund, because they are actively managed by real people and systems, the fees are naturally going to be a lot higher than the passively managed funds. I mean, at the end of the day, they have to make money in some way, right? So with that, expect to see things such as management fees and transaction fees, which can really add up over time. One thing I'll have to say is it's really important to weigh all of these fees against your potential reward when deciding if a mutual fund is right for you. And I guess personally, whilst I can't give you direct financial advice, I would never actually invest in a mutual fund myself, mainly because of how aware I am of the damaging fees on the returns, but it also could just be the fact that I'm more interested in this kind of thing compared to the everyday person that just wants to make their money go further. A good example actually is my mother. Despite me being her son, she has zero interest in conversing about finances or any motivation to learn, so she opted to go with a mutual fund with a company, fully understanding the fees and the impact that it has. You see, she's absolutely fine with that and completely understands it, but somebody else may not be. It really just depends on your goals and your situation. But other than that, that's mutual funds in as quick and simple form as possible. I hope this video helped, and I'll see you in the next one.